In December 2025, silver prices shattered records, surging past $64 per ounce, a 115% increase year to date. While most Americans focused on holiday shopping, China executed the final phase of a multi-year strategy that aims reshaping global technology supply chains and draining hundreds of billions from the U.S. economy. On January 1st, 2026, China will implement strict export controls on silver, restricting up to 70% of global supply. This isn't about coins or jewelry. This is about solar panels, electric vehicles, semiconductors, and military systems. And through strategic market positioning, China has created economic pressure, translating into hundreds of billions in costs, supply vulnerabilities, and industrial disadvantages for America. Today, we're examining how a centuries-old precious metal became a 21st century weapon, and why the U.S. just designated silver as a critical mineral, essential to national security. Let's start with fundamentals. Why does silver matter in 2025? Most people associate silver with investment or jewelry, but industrial use now accounts for more than half of global silver consumption, and this proportion continues expanding rapidly. Here's the critical detail. Silver is irreplaceable in many high-tech applications. Silver's unique properties make it essential. Silver is the most conductive metal on Earth, both electrically and thermally. This isn't a minor advantage, it's physics. Every solar panel uses silver, with demand from the photovoltaic sector skyrocketing by 64% year on year in 2023. Electric vehicles use up to 3 times more silver than traditional cars. A single smartphone contains approximately 0.35 grams. Military applications, from missiles to radar systems, depend on silver's conductivity and reliability. The 2025 market reality. Global silver demand is expected to remain around 1.20 billion ounces in 2025, with industrial fabrication forecast to grow by 3% and surpass 700 million ounces for the first time. This represents a historic milestone. The Silver Institute estimates global IT power capacity increased approximately 53 times, from 0.93 GW in 2000 to nearly 50 G dollars in 2025, driven by AI infrastructure, data centers, and cloud computing, all requiring massive silver inputs. The supply crisis. Here's where it gets critical. Silver supply is relatively inelastic. Unlike oil, where producers can quickly ramp up production, silver often comes as a byproduct of copper, lead, and zinc mining. Primary silver mines account for only about 25% of supply. When demand spikes, supply cannot respond quickly. The global silver market is experiencing its 5th consecutive year of structural shortfall, with a 2024 deficit estimated between 176 and 215.3 million ounces, the second highest in over 2 decades. That's 215 million ounces of demand exceeding supply every single year. Since 2010, the silver market has accumulated a supply deficit of over 580 million ounces, an entire year of average mine output. U.S. strategic vulnerability. The United States imports approximately 70% of its silver. Domestic production has declined steadily since the 1990s. Meanwhile, America's industrial needs have exploded. In November 2025, the U.S. Geological Survey added silver to its list of critical minerals, commodities essential to economic or national security with supply chains vulnerable to disruption. This designation came just days after China announced its export restrictions. This creates profound strategic exposure. America needs massive quantities of a material it doesn't produce for technologies essential to its economic and military future. Now let's examine China's position and how it differs fundamentally from the U.S. approach. Dominating the downstream, China doesn't need to mine silver to control its strategic value. Instead, China has systematically dominated the industries that consume silver and the supply chains that process it. China produces over 80% of the world's solar panels and is the leading producer and consumer globally. It manufactures roughly 60% of global electric vehicle batteries. Chinese firms control significant portions of semiconductor packaging and consumer electronics production. But here's the hidden leverage. China controls 60-70% of global silver refining infrastructure, making it the world's dominant gatekeeper to newly mined silver worldwide. The refining choke point. Even silver mined in Mexico, Peru, or Australia often gets shipped to China for refining. This creates a bottleneck China can exploit without controlling mines directly. Control the refining, control the supply, regardless of where ore comes from. Strategic stockpiling, the theory. While unconfirmed, market analysts have theorized China may have pursued strategic silver accumulation similar to its documented gold reserve strategy, which saw China's gold reserves grow to 2,279.57 tons by the end of 2024. Several factors support this theory. Unexplained price suppression during years of structural deficits, massive refining infrastructure build-out, and patterns of inventory movements through Hong Kong. Whether or not systematic accumulation occurred, the outcome is the same. China now sits at the center of global silver flows with unprecedented leverage, the export control bombshell. In late October 2025, China's Ministry of Commerce announced new export restrictions on silver effective January 1st, 2026, requiring government-approved licenses for silver shipments through 2027 at minimum. Only large, state-certified companies producing at least 80 tons of silver annually will qualify for export licenses, effectively creating a quota structure. This policy affects approximately 60-70% of global silver supply that historically flowed from Chinese operations to Western markets. The immediate market reaction: silver prices experienced extraordinary volatility during December 2025, reaching record highs of $65.89 per ounce before retreating to approximately $62.57 within hours. As of December 12, 2025, silver was trading around $64.57, representing approximately 116% gains year to date. Silver lease rates in London rose to 809% in mid-December, indicating severe physical market tightness. For context, normal lease rates hover around 0.5 to 1%. Rates of 8 to 9% signal panic level demand for physical metal. Now let's calculate the real economic impact on the United States, where that 400+ billion figure comes from. Direct industrial costs: when silver prices double, as they did in 2025, every industry using silver faces immediate cost increases. U.S. solar industry: assuming 25 million ounces of annual silver consumption for domestic solar manufacturing, a price increase from 28 January 2025 to 64 December 2025 represents an additional $900 million in direct materials costs annually. Electronics and semiconductors: U.S. consumption of roughly 80 million ounces annually at increased prices adds approximately $2.9 billion in additional costs. These are conservative, direct calculations. They don't include downstream price increases passed to consumers, reduced competitiveness of U.S. manufacturers, supply chain disruptions and production delays, emergency sourcing premiums, trade balance deterioration. Here's where the damage multiplies. In October 2025 alone, China exported record volumes exceeding 660 tons of silver, with much going to Western financial centers. At current prices, 660 tons equals roughly $1.4 billion in a single month. Over a 5-year period of elevated silver prices and increased imports, assuming $15-20 billion in additional annual silver-related trade costs, direct metal purchases, plus embedded silver and imported goods, the cumulative impact reaches $75 to $100 billion. Technology sector competitiveness. But the real cost isn't just imports, it's lost competitive advantage. U.S. solar manufacturers cannot compete with Chinese firms that have guaranteed domestic silver access at lower effective costs. This translates to market share losses worth tens of billions annually. Semiconductor manufacturers face similar disadvantages. When your competitor controls the supply of critical inputs, they can underprice you, even with comparable technology. The Biden administration's Inflation Reduction Act allocated $369 billion for clean energy. A significant portion is undermined when Chinese competitors have structural cost advantages through resource control, compounding through supply chain effects. Consider electric vehicles. A Tesla Model 3 uses approximately 1 to 2 kilograms of silver. At 64 ounce, approximately $2,056 per kilogram, that's $4,000 in silver per vehicle. When Chinese EV makers have guaranteed silver access and U.S. manufacturers face spot market volatility, the competitive disadvantage is severe. Applied across millions of vehicles, thousands of products, and entire industrial sectors, the compounding effect easily exceeds $300 billion over a 5-7-year period. Financial market exposure: J.P. Morgan recently closed silver short positions totaling 200 million ounces, 6,950 tons, and accumulated 750 million ounces, 23,137 tons of physical silver. When major financial institutions take such positions, it signals expectations of dramatic price increases. U.S. pension funds, insurance companies, and investors holding short positions or derivative exposure face potential losses as prices rise. The COMEX situation: around Thanksgiving 2025, over 7,300 COMEX contracts, approximately 36.7 million ounces, allegedly stood for delivery, possibly forcing behind-the-scenes negotiations. J.P. Morgan subsequently moved 13.4 million ounces from registered, deliverable, to eligible, non-deliverable inventory. This suggests physical silver shortages at official exchanges, unprecedented in modern commodity markets. When derivatives markets face delivery failures, systemic costs can reach into tens of billions. Infrastructure and defense costs: U.S. military systems, from missiles to communications equipment, require silver. Defense contractors facing 100% plus price increases pass these costs to government contracts. Across hundreds of programs, this translates to billions in additional defense spending. Adding it up, direct industrial cost increases. $75 billion per five-year cumulative. Trade balance deterioration. $100 billion. Lost competitive advantage and market share. $150 to $200 billion financial market exposure and derivative costs. $75 billion defense and infrastructure overruns. $50 billion conservative total. $525 billion over a 5-7 year period, centering around $400+ billion. This doesn't include opportunity costs, innovation delays, or strategic disadvantages that compound over decades. This isn't the first time resource control has been weaponized. Let's look at historical precedents. 1970s oil embargo. The 1973 OPEC oil embargo caused immediate economic shock, gas lines, inflation, recession, but the long-term cost was far higher. Estimates suggest the embargo and subsequent oil shocks cost the U.S. economy $500 billion to $1 trillion in 1970s dollars through reduced growth, inflation, and structural economic changes. The silver situation mirrors this pattern. Immediate price shocks combined with long-term structural disadvantages. China's rare earth strategy, 2010. In 2010, China restricted rare earth exports during a territorial dispute with Japan. China has a documented pattern of using export controls on critical materials previously demonstrated with rare earths and now extended to tungsten, antimony, and silver. Prices for rare earths increased 401,000% within months. U.S. and Japanese manufacturers faced supply crises. The total economic impact exceeded $50 billion, and Western countries spent billions developing alternative supplies, investments that took 5 out of 10 years to materialize. China's silver strategy follows the same playbook, but silver affects far more industries than rare earths ever did. Japan's semiconductor dominance, 1980s. In the 1980s, Japan controlled 50% plus of global semiconductor production. U.S. manufacturers lost massive market share. The Reagan administration eventually brokered trade agreements and invested billions in domestic semiconductor development. The parallel: when competitors control critical technology inputs, market share losses mount quickly, and recovery takes decades plus massive government intervention. The pattern: resource control, doctor industrial advantage, doctor market share gains, doctor long-term economic dominance. China studied these historical lessons. The silver strategy combines elements of all three: OPEC's supply control, rare earth strategic restriction, and Japan's industrial dominance. So where does this leave the United States? Near-term challenges: 2026, 2027. The current global silver shortage of approximately 2,500 tons annually could increase to 5,000 plus tons per year once China's restrictions take full effect. Industry analysts interpret China's policy as prioritizing domestic industrial needs, particularly for booming solar panel and electronics manufacturing sectors. U.S. industries will face higher costs, supply disruptions, competitive disadvantages versus Chinese firms, pressure to relocate manufacturing to China to secure silver access. Long-term structural issues: the U.S. faces a multi-year challenge to develop alternative supply chains. Mining expansion takes 7 to 10 years from discovery to production. Refining infrastructure requires billions in investment and years to build. Recycling infrastructure needs development, currently inadequate for market needs. Meanwhile, despite potential economic headwinds, industrial silver demand is expected to continue growing, driven by green economy applications, AI infrastructure, and technological advancement. U.S. response options: the U.S. government has several potential responses. Strategic reserve creation: the U.S. could establish a strategic silver reserve similar to the Strategic Petroleum Reserve, though this would require tens of billions in upfront investment. Domestic mining incentives, tax breaks, subsidies, and streamlined permitting could accelerate U.S. production, but output won't match current needs for years. Recycling investment: silver recycling rose 6% in 2024, reaching a 12-year high of 193.9 million ounces. But scaling this further requires major infrastructure investment. Trade policy: the designation of silver as a critical mineral paves the way for potential Section 232 import tariffs, though this could raise domestic costs further. Technology alternatives: some industries are exploring silver reduction, copper substitution, in certain electronics, performance trade-off, thinner silver layers in solar panels, efficiency trade-off, alternative battery chemistries, us for EVs, years away from commercial scale. None of these eliminate silver dependence. They only reduce it marginally. geopolitical implications. Market analysts suggest China may use silver export controls as geopolitical leverage, similar to previous rare earth restrictions. Countries dependent on Chinese silver face pressure to align with Beijing on trade, technology, and foreign policy. This isn't speculation. It's the documented pattern from rare earths. The U.S. and allies need coordinated response strategies, possibly including joint strategic reserves, shared R&D on alternatives, coordinated trade policy, supply chain diversification agreements. Let's bring this together. What we've established. Silver is critical to modern technology, solar panels, EVs, semiconductors, AI infrastructure, defense systems. The U.S. imports 70% of its silver, with declining domestic production. China dominates global silver refining, 60-70% of supply flows, and is implementing export restrictions, effective January 2026. Silver prices have surged approximately 116% in 2025, with 5 consecutive years of structural market deficits. The cumulative economic impact on the U.S. economy through direct costs, trade effects, competitive disadvantages, and strategic exposure conservatively reaches $400+ billion over 5 or 7 years. The balanced view? It's important to acknowledge uncertainties. We don't know if China systematically accumulated silver or simply responded to market dynamics. Export restrictions might be modified based on negotiations or domestic needs. Alternative technologies could reduce silver dependence faster than expected. Market prices could stabilize and/or decline if new supplies emerge. But the fundamentals remain. Structural supply deficits continue. Industrial demand keeps growing. U.S. strategic vulnerability is real and documented. China's leverage is substantial and increasing. The broader lesson: this isn't just about silver. It's about critical materials, supply chain vulnerabilities, and economic security in an interconnected world. The U.S. learned painful lessons from rare earths, semiconductors, and now silver. Each time, the pattern is similar: gradual dependency, sudden supply restrictions, scrambling response. The question is not whether China's silver strategy will cost America hundreds of billions. We're already seeing that impact. The question is whether the U.S. will develop a comprehensive critical materials strategy before the next shortage hits. Because silver won't be the last resource China uses for economic leverage. It's just the most recent example of how control over seemingly mundane materials can reshape global economic power. Final thought: when silver breaks out of a 45-year price range and gets designated a critical mineral, within days of China announcing export controls, we're witnessing a fundamental shift in the global economic order. The age of cheap, abundant critical materials is ending. The era of resource competition is here, and the United States is playing catch-up.